by teachers residing abroad right now?
Okay. Okay. No, my study leave has been ended, and I'm on duty now. So I'm taking your class from Dhaka.
So we eagerly were waiting for your class. So welcome back.
Thank you. Uh, it's my opportunity to meet you in your terminal semester before you're signing off from the department after hectic 4 years. Is it?
Yes, sir.
Okay. We have around 97 participants till now. Okay, let's begin. I think you all have got my course outline.
Yes,
Yes,
sir.
sir.
So have you got time to go through the course outline? And you have got some idea that what we are going to learn, or what for what purposes we are going to spend time together. It's about managing portfolio. So I think as I will proceed, I'll proceed. You will get it clear that what we are trying to learn and what are our course objectives. But before that, I will request you, if you have not got time still to read the course outline, please go through this outline at least for 2 times, so that you will have an idea that what will be the benefits for spending around 25 or more than 25 classes on this course. Okay, so without knowing the benefits or without knowing the outcomes, it's not worthwhile to spend time, and you are spending more resources in terms of time and in terms of money as you are attending online classes from your own places. Okay, so these are our textbook. There will be several reference books. The matter is that we don't have complete contents from one text. So we'll try to cover contents from different text, and we'll try to tell you that which contents will be available in which text, and we'll also try to provide the soft copies of the text, as it has become difficult for you to collect the physical copy. And if anything is covered outside of the text, we will try to give you the reference or the handout. So if you have gone through the course outline, I think you have seen the course plan, and you see the course plan has uh, some different structure, like in week 1 class 1 is repeated again in week 1 2 class 1 4. It is because we are sharing the course, so some contents will be covered by me and some contents will be covered by Shojib sir. And I think you already have taken one class from Shojib sir, right?
Sir,
No, sir.
actually, sir was not
Actually,
available to take our classes. So he
Okay, this is
postponed his class in the next week.
okay. Okay. Okay, so the purpose of separating this class number, some class are underlined, and some classes are not underlined. The classes which are not underlined will be taken by me, and the classes which have been underlined will be taken by Shojib sir. Okay, so it is not your focus, it's focus of the faculty members. The focus of you should be on the objectives and the contents and the references from where we will try to cover the contents. Okay, So you will get the idea if you go through. And the teaching methodology, evaluation scheme, and special notes, these are almost similar for you, almost similar to the courses which you took with me in earlier semesters. Okay, so the rules are almost similar. So this is about course outline. And how many of you are planning to work in financial industry or bank and financial industry after finishing your undergraduate degree?
Sir, I was thinking about going into the banking sector. I might apply for MTO positions after completing BBA or MBA.
Okay, fine. And anyone else? No one? Not decided yet?
Yes, sir.
It's your terminal semester. And if you don't like to uh, take the post-graduation, it is your tertiary degree. That means you are at the end of your academic life. So it's high time to decide about your career plan, the industry where you are going to work. Okay. So let's talk about the idea of our course at the very beginning of this course, the portfolio management course. Okay, you're seeing my PowerPoint.
Yes, sir.
Okay, fine. Have you seen this kind of fruit shops?
Yes, sir.
Hmm?
Yes, sir.
Okay. Okay. I have mentioned here that the title I have given to this slide is portfolio. Can anyone tell me why I have chosen this title for this slide as portfolio?
So there are different kinds of fruits that we can see here, and I think it just remembers it is like a portfolio.
Okay, that means the fruit seller has invested his wealth not only in single fruit but in multiple type of fruits. There are some motivations why he has not invested all of his money to the to only one fruit which would give him highest margin. Rather, he has taken a number of fruits in his shop, and you know very well these fruits have different types of margin. All fruits are not profitable to the same extent, is it? What do you think?
Yes, sir. The margin is different
Yes, sir.
for every
The
fruit.
margins are different. You know very well what I'm trying to mean by the margin. Okay. So, if I just take one example, that there is red grapes, is it? You see this portion, red grapes.
Yes, sir.
Yes, sir.
Okay. I think, except the date, here are some packets of dates, right?
Yes, sir.
Okay. I don't know about the price of the dates, which has been kept by this shopkeeper, but I'm just assuming that for simplicity, uh, the grapes which are here, you see the grapes? I have outlined the grapes here. Okay. So can you expect uh, just in general sense, the cash flows will be higher from red grapes compared to other fruits available. The cash flows from grapes, I mean the net cash flow, not the gross inflow. I'm meaning the net flow. That means cash outflow in excess of the, cash inflow in excess of the cash outflow. The expected cash and net cash flow will be higher for red grapes. Can we assume that?
Yes, sir. Profit margin
Yes,
for
sir.
grapes is higher than other fruits.
Okay. So you learned from your finance course, the fundamentals of finance, that you should pick the investment, or you should pick the asset, you should pick the security which will give you the highest amount of cash flow.
Yes, sir. We have learned that from our fundamentals of
Because you know that
finance course.
price or value is to be the discounted cash flow to be happened in future. So if you take the item which will give you the highest amount of cash flows, you are taking the asset, or you are taking the fruit here in this case, which will give you the highest value. Okay. So if this was true, if the finance concept was true, what you have learned, that I will invest in that asset or that security which will give me the highest cash flow all time, uh, would the shop, uh, would the fruit seller invest all of his money in red grapes?
No, sir.
If this was, if the statement was true, that you should invest in that security which will give you the highest cash flow. If it
Sir,
was,
not all time, yeah. Not
yeah.
all.
Okay, so there are some factors which have not been considered in that simple statement. Okay, so you have understood the reality that fruit seller has not allocated all of his money in single fruit which would yield highest amount of cash flows. Okay, but forget about the uh, forget about this fruit seller and think of our mother. Okay, we all have mothers.
Yes, sir.
Yes,
Okay,
I do, sir.
okay, we all have mothers, and uh, the thing is that if our mom or mother gets some money, I'm trying to mean it is not that kind of only 100 taka or 200 taka like this. I'm trying to mean it's kind of 50,000 or kind of handsome amount of money. If our mother gets this amount of money, she has a tendency to buy what? Fruits. She has
So jewelry,
all mothers have
gold jewelry.
tendency to buy fruits like this. What is
First of
this?
all, sir, the commodities. All mother try to ensure
Okay,
more commodities
okay.
for her family.
Think of the amount what I mentioned. Don't forget the amount what I mentioned. I mentioned the handsome amount of money. When your mother has got the handsome amount of money, she will not go to the kitchen market, to use the handsome amount of money to buy the commodities. The task of buying commodities is on your father. The responsibility of buying commodities is on has been taken by father usually. Okay, But what I'm trying to point out that if our mother get some handsome amount of money like 50,000 or 2 lakhs or 5 lakhs, this kind of amount, okay, what is the general tendency of our mother?
She
So to
will put
invest
the
in
money to the bank or invest in
golden.
Uh-huh.
like সঞ্চয়পত্র.
Okay, okay, but that is also one kind of nature. But what is the common nature, if I ask from you?
Sir, my mother will invest in golden jewelry.
Okay,
And
anyone else?
So my mother will buy clothes for her and also for us.
With 50,000?
No, sir. It's just one type of expenditure. It's just one type of expenditure.
Okay, don't forget the amount. I have not mentioned
Maybe she will
1,000,
save some
2,000 or
some amount
5,000.
for
I
this.
have mentioned the amount
Okay, sir.
50,000, 1 lakh, like this kind of amount, a handsome amount.
Yes, sir.
What do you think?
You
Household
may put the money in DPS, deposit pension scheme, for the
DPS.
future.
Okay. And you
household
know,
appliances.
household appliances. Okay. So these are some changing nature, but historically, in South Asian region, females have tendency to put all of their money, to put all of their savings in gold. How many of you disagree? Have you got my point? Historically, the South Asian females have tendency to use most of their savings to invest in gold or spend their money to buy gold or
Yes, sir.
jewelries.
No,
How
sir.
many of you disagree? Not yes. I'm asking how many of you disagree that, sir, I disagree with you.
Sir,
You?
Sir, I disagree, sir.
Okay. So what's your point?
Sir, nowadays gold very much. Gold is such type of metals that can be secured. Like if we take the money in bank or other financial institutions. So security matters in this region also.
Okay, security matters. But what's the point of disagreeing with this statement? I mentioned that not nowadays. I mentioned that historically, our South Asian females have tendency to pour almost all of
I
their
agree
savings,
that to me that
savings into gold, and the tendency to invest in DPS or keep money in saving certificate or buying home appliances are kind of pattern of nowadays, not the historical pattern. Have you got the point?
Yes, sir.
Yes, sir.
Okay. So that's why it is said that approximately 33%, approximately 1/3 of the gold reserve in the world, approximately 33% of the world gold reserve is in the South Asian region, held by the female population. Got it?
Sir, one irrelevant question, sir. এখানে
Yeah. হ্যাঁ, বলেন।
Sir, sir, is gold a good investment for long term?
I'm not considering right
Sir.
now whether gold is a good investment or saving is a good investment. I'm not. I'm not mentioning anything about that. I'm just trying to point out that the tendency of our female population in our region, that they try to put almost all of their savings into gold. I'm not making any argument. What is the is there any good prospect or bad prospect with investing in gold? I'm just trying to make it clear how many of you agree with the fact that our female members have common tendency like this to buy gold whenever they get a handsome amount of money. Have you got my point? What I'm trying to make it clear?
Yes, sir. We got the point, sir.
Okay, it's not about I'm trying to think of which investment is good or which investment is not good. Okay, the point, the concluding point, what I'm trying to make it that you recently have experienced that, or you recently have seen that gold price has gone up, and gold price again fell down from the highest amount in the history, highest price in the history. But still, there are some times when gold price goes down. Okay, so if you put all of your almost all of your savings in gold, is it a portfolio? Or if you have a tendency to invest all
No,
of
sir.
your savings in only one single asset, are you trying to think of investing in portfolio or single asset?
No, sir, this is not.
You're trying to
Single asset.
you are trying to put all of your eggs in one basket. You probably have heard about this statement very commonly. Is it that
Yes, sir.
if I invest all of my money in one investment, obviously it can be a good investment. It is a good investment. Otherwise, I would not rely of putting all of my money in one investment. Okay. So if it is your tendency, that means you are not considering the portfolio. You are considering investing in single asset. Okay. So if you are not unfortunate, you probably have visited my finance classes on this date, and you saw this kind of photo I shared with you. Can you recall?
Yes, sir.
Yes, sir.
I shared this
Yes, sir.
photo
Yes, sir.
mentioning that this is my new portfolio. Okay. So what I did when I was outside of the country for a study purpose, I tried to begin investing in world stock market and world financial market, and I started investing with this small amount of money. It is approximately how much? 50 pound, right? 50 pound, is it? You see the figure?
Yes,
Yes,
sir. We
sir.
can see the figure, sir.
Okay, fine. So out of this five instrument, which one seems more outstanding investment to you? I'm not asking any figure, just I'm trying to think of your perspective. What do you think, which investment will be very good or would be very good out of these five, or best?
Sir, Apple?
Apple. Okay,
Apple.
fine.
Apple, sir.
Yes, sir.
Okay, but out of 50, it's a very small amount. Out of 50 pound, I invested less than one fourth of my small amount to Apple. Have you seen? Out of the 50 amount of small investment, I didn't invest total 50 pound in Apple, though I knew, like all of you, that Apple would be a very promising investment for future. But I invested less than less than 25% of my small investment in Apple, and I also invested in other tech stock, Alphabet and Microsoft. Apart from that, I invested Volkswagen and Ford Motor. So how many sectors I have taken exposure? In how many sectors I have taken exposure?
It's a two sector, technology and transportation.
Technology and
or transportation.
Technology and automobile. Okay.
Automobile.
Okay. So that is the concept of portfolio, that whatever the amount of investment, the person can be a food seller, the person can be a student like me, or the person can be a very wealthy individual, or it can be an institution. It is very unlikely that we will end up investing in only one asset or one investment, whatever the promising feature of that particular investment has. Okay. So what do you expect? This is the date of March 3, 2020, right? So right now we are on October 13, 2020, today's date, right? Okay. What do you expect? My investment has gone up from this amount. My portfolio size should grow up in this, how many months? Around 7 months. And do you expect that my investment is still limited to 5 instruments?
No, sir.
Okay, so you expect that my portfolio has grown up, or I tried to invest more than this amount, and I tried to take exposure to the sectors which is greater than which is greater than 2 sectors from here, or which is higher than 2 sectors from here. Okay, so let's see the updated. Let's see the update. Okay, how much is my account value right now? It's around 4,500 pound plus. Okay, so it is the portfolio market value, not my portfolio investment. It is the account value. That means it is the market value. Got it? So this is the, if we sum these two numbers, I will get this number. If I sum this number, I will get this number. Okay. What do you see? The slice, what you saw in earlier, the portfolio was sliced into how many parts? 1, 2, 3, 4, 5. You see the slice? This is one. It is one. It is one. It is one. This is one. How many slices? 5 slices?
5.
5 slices. Okay. Which slice seems to be larger or largest compared to other slices? This one?
Apple.
This color? Apple. Okay. So let's see the update of the slices. And you see the number of slices has grown. It's not only 5 slices right now. It's more than 5 slices, is it? You see?
Yes, sir.
Okay. So right now I have investment in approximately 23 securities, which was 5 in March 3, 2020. Okay. So still now, in which stock I have the highest exposure?
Apple.
Apple, I still have the highest exposure, but earlier it was around 23.5%. It has gone down to less than half of earlier amount, earlier percentage. You see,
Yes,
less
sir.
than half. Okay. Okay. So let me highlight some instruments to you. You see this company, stock, Gilead Sciences, Walmart, then Group Hub. You see these items, new items, which was not in this
Ye-
portfolio.
Yes, sir.
Okay. Can anyone tell me what was the motivation of purchasing this instrument, this equity instrument? Gilead Sciences. I think many of you have heard about this company name very recently, or last 4 months or 5 months.
They're trying to vaccine of COVID-19, sir. And if they get success in this, their market share will go up. The value will go up also, sir.
Okay, fine. Okay. You heard about their product name, Remdesivir?
Yes, sir. Yes, sir. Remdesivir.
Okay. Okay. So you are excited that I have taken position and I'm going to make a good win or make a good amount of money from this investment. So I'll show you in next slide what is the current situation. Okay. And can anyone tell me about the Group Hub? Have you heard about this item or this company? All these are equity instrument.
No, sir.
Okay. You heard about the Shohoj Food, Pathao Food,
Yes, sir.
and
Yes, sir.
Uber Eats. So this is one of the leaders in North America, particularly in USA, for food delivery. And you know very well the business of delivering food to the home has grown up significantly due to the lockdown situation. So what do you expect? Their cash flow will go up.
Yes, sir.
Okay, so that was the motivation. And why I took position in Walmart? Because people started to buy from the super shop instead of going to the local shops, or sorry, not local shops, local market. People have grown their tendency to buy from the super shop to reduce their chance of getting affected by COVID. And they are also buying their shopping through online. And that's why the cash flow of Walmart, or in our country, Bangladesh, the Shopno has experienced, and other super shops also experienced multiple time increase in their cash inflows or increase in their sales due to COVID-19 situation. Okay, so considering that situation, I increased my position to these stocks. Okay, have you got it?
Yes, sir.
Okay. So I mentioned about the 23 instrument here. This was a kind of summary, but you see the total list. You see the total list?
Yes, sir.
Okay. You mentioned about the Gilead Sciences. Okay. How much loss I'm incurring? Uh,
Sir, can you please zoom it?
you can't see it. It can I increase the slide zoom?
At 22%.
Which one? Oh, okay, fine. Okay. You see, Gilead Sciences, I have outlined the number. You see, I am incurring losses around 22.909%. You see?
Yes,
Yes,
sir.
sir.
Okay. So was it a good investment? If I consider right now, I have invested to this instrument approximately, it has become around 6 months.
So right now it doesn't seems like a good investment.
Okay. Because
But sir, from future perspective, it's a good
okay, it has been come out
investment
that
because they can have the vaccine for COVID.
okay, it has been found that there are some issues with the vaccine invented by this company, and research has already found that giving the standard medicine already available in market and giving the medicine invented by Gilead Sciences does not make significant differences in the recovery of COVID patient. So in that case, what do you expect? Will it be will it give a blockbuster performance in future days if it becomes true?
No, sir. I am skeptical, sir.
Okay. That's the reason why investors have become pessimistic and they are putting less weight on this stock. Okay, but what about the group hub? Group hub, you see, I have gained around 25.44%. You see this number?
Yes,
Yes,
sir.
sir.
Okay, fine. So what do you think? The amount of loss what I am incurring from Gilead Sciences in terms of monetary number, it is around 55.22 pound, 55.52 pound. But from other investment, I have been able to make up these losses.
Yes, sir.
You see, I have generated around 186.1 pound gain from Facebook. So I have been able to make up these losses. Would it be possible if I was so excited and invested all of my money in Gilead Sciences? Have you got my point?
Yes, sir. Yes, sir.
If I was super excited with the Gilead Sciences, okay, in that case, it would not be possible to make up the losses because in that case, I would invest all of my money or almost all of my money or a lion's share of my money in one particular stock or particular equity instrument. Okay, so that is the good side of portfolio or having a portfolio. Okay, so it's about my portfolio in world stock market, particularly in US and UK market, and one item is probably from Switzerland. Okay, so let's talk about Bangladesh market. It is my portfolio in which date? You see the date?
Yes,
Yes,
sir.
sir.
You see any item
Exactly one.
approximately exactly 1 year ago. Okay, October 14, 2019. How much loss I incurred from this first instrument? 81,761 out of my total investment of this around close to 1 million. Okay, and I had unrealized gain from this Singer Bangladesh, and I also incurred losses from Square Pharma, and the gain and losses from the mutual funds have not been reported here. Okay, but the reality is that I incurred gain from this, and I incurred loss from this investment. Okay, you see my annotation I'm making. Okay. So out of approximately 1 million investment, approximately exactly 1 year ago, I had losses in total. How much? 56,156 out of my total.
56,000.
Yeah, 56,000 taka. Is it too small? From perspective of a person who has started his career only 4 years back.
So it's a huge money, sir.
It's a
amount,
huge money. Okay, fine. So the point to be noted that I started making investment and started making investment in 2011 when I was third year student in BBA Finance. Okay, so you want to see the update of this portfolio?
Yes, sir.
Yes, sir.
Okay. Before seeing the before getting the update of this portfolio, let's check that how much excited I was to invest in Grameen Phone. Divide this number by this number.
Above 50%, sir.
Above 50%. Okay. And second excitement was with Square Pharma. Okay. So it's approximately close to 25%. Okay. So as Grameen Phone cost huge amount of losses for me, it's around 16.16% based on my investment in Grameen Phone. So the contribution of loss from Grameen Phone is significant in my portfolio loss. Is it true?
Yes, sir.
Yes, sir.
Okay. So let me ask you a simple question. If I would not invest any amount of money in other companies or mutual fund other than Grameen Phone, what would be my loss percentage? Would it be 5.78% negative, or it would be 16.16% negative?
16.16% negative.
So for considering the portfolio or for making investment in a portfolio, I have been able to reduce my losses from 16.16% to 5.78%. Okay. So you want me to show the update of my portfolio? This is today's portfolio based on the yesterday market price. And you should be happy because my loss has gone up over the last year from 56,000 to it is now
92,000.
92,000 approximately. Approximately 92,500. Okay. So my investment has grown up slightly over the year. Okay. It's marginal above the 1 million. Okay. Still, Grameen Phone loss was 16 point something percentage in last year. Now the loss is around how much? Based on my investment. Based on this invested figure. 12.38%. But in terms of portfolio, what is my loss percentage? 8.87%. It is not 21.44%. It is not 12.38%. It's not 11.06%, but it is 8.87%. How it has become possible? Because of considering portfolio approach, because of investing in more than one instrument, not to concentrate in only one instrument. Have you got the issue?
Yes, sir.
Have you got the issue, or have you got the point why we need to think of the portfolio when we make investment, or why investors typically think of the portfolio perspective when they have money and they try to invest money for achieving some objectives? They don't try to put all of their money in one basket. They try to allocate their money in several baskets to diversify their potential downside or upside trend, or downside or upside risk arises from upside and downside movement. Okay. Now let's think from the perspective of an institutional investor. You see the institution name? This is the H Bangladesh Mutual Fund. Okay. It is of which date? September 30, 2019. And look at their portfolio condition. Okay. Should I zoom it?
Yes.
Okay. Their total portfolio is in loss, approximately how much? 6 million. How much? Close to 7 million losses out of their investment of 205 million. Okay. But let's look at their portfolio structure. You see, out of their total losses, which item is contributing much to their losses? Okay. You see, this is the highest in terms of absolute. Sorry, this is the highest. Is it?
Yes, sir.
IDLC Finance. Okay. So IDLC Finance has contributed significantly to their portfolio losses, and the second one is Olympic Industries, and the third one is Square Pharmaceuticals Limited, and fourth one is Bragg Bank Limited. Have you got my point? I have mentioned about the 4 instruments which have contributed to the total loss of this portfolio of this institutional investor. Okay. So let's look at their investment. You see, they have invested approximately it was total acquisition cost. They don't have provided the proportion invested here. And this is the investment in Bragg Bank Limited, a significant amount out of their portfolio. And this is also a good amount of investment, Olympic and Square Pharmaceuticals. Okay. So if you look at the portfolio of Bangladeshi individuals and Bangladeshi institutions, it is very likely that you will see these 4 instruments common. Okay. One is Grameen Phone, another one is Square Pharmaceuticals, another one is Bragg Bank Limited, another one can be IDLC Finance, and another common item is Olympic Industries Limited. Okay. So if this institutional fund didn't invest all these equity instruments, approximately more than 20 instruments, they invested all of their money in Grameenphone, considering the prospect of Grameenphone for delivering data services during COVID-19 and having a good amount of cash flow from selling the data to its customers, what would happen to this institutional fund? It would incur a huge amount of losses.
Yes, sir.
So they also consider investing in a portfolio rather than concentrating in a single instrument. Okay. So let's see the update of this Edge Bangladesh Mutual Fund. The update is available on this date, not available to current date. So you see the number of equity instruments has gone down from the earlier year. All these items are not available right now. Okay, they have eliminated some item by selling or by discarding from their portfolio. Okay, still you see I have mentioned some companies to you. You see Scare Pharma is still there, Bank is still there, then Grameenphone is still there. Okay, got it? Okay, and earlier they didn't invest in bond, but now they started investing in bond. They started investing in treasury bills. Okay, last year their portfolio loss was approximately how much? 6 million, close to 7 million. Right now, it's around close to 17 million. But over the time, their investment has gone up or has gone down. Their investment in terms of market value, in terms of acquisition cost, their investment was around 205 million. Now their investment has shrunk or has gone up.
Shrink.
But their investment has gone down, but their loss has gone up. So don't think that the loss is incurred only by the individual investor. The loss is also incurred by the professional investor who are behind this mutual fund. They are also incurring losses. Okay, so we are highlighting the loss does not mean that they are not generating gain. They are, you see, in updated number, all items are in loss except this one. Which one? Copper Tech Industry. And you know very well what is happening to the Walton High Tech right now. It is giving a handsome amount of gain to the people who invested in or who have got opportunity to invest in Walton High Tech. So we are not elaborating discussion on that. So have you got the portfolio picture that investors don't invest only in single instrument, but invest in more than one instrument? Okay. But what are the reason? Why you need to think from portfolio perspective? Okay. Usually people have a tendency that if I give you 100 taka or if you have 100 taka, you like to invest equally to the available investment you are considering. For example, you are considering two investment. One is A, another one is B. And you don't have much information about A and B, but you like to invest. So if you have 100 taka, it is very likely, which is usually known as the net diversification. What is the term I have used? This kind of Nate? This kind of naive diversification. You have 100 taka. It is very likely that you invest 50% to A into A and 50% into B. So do you think that it is a good diversification?
So maybe not based on the stocks of the companies.
Okay. The thing is that if these are similar companies, A and B, they are moved together, kind of, you can think of the companies Square Pharmaceuticals and Beximco Pharmaceuticals. Okay. So their correlation are expected to be higher. You learned about the correlation from your basic statistics course.
Yes, sir.
So you expect that their correlation is very high because they are in same industry, they are engaged in similar business. Their correlation between what? Correlation between their stock prices. Correlation between their stock prices is expected to be high because they are in similar business. Okay. So if pharmaceutical business incurs loss, A is expected to incur loss, B is also expected to incur loss, right?
Yeah.
So in that case, will it be possible to offset loss of one company by loss from another company?
No, sir. No, sir.
It is not possible. Rather, if we invest like a company A and another company, for example, P. Let's think of a company A is in pharmaceutical business and the P company is in utility business. Okay. So in that case, it is not likely that utility and pharmaceutical will, they have a correlation, but it will not be very high. It would not be very high. In that case, if A incurs losses, some of their losses can be offset by the gain from P. Okay. So you need to, when you construct a portfolio, for example, I'm thinking of a portfolio AP. I'm thinking of a portfolio AP. So usually people have a tendency not to consider the investment in terms of their interrelation. They have a relation, what I have mentioned, correlation. What I have mentioned, correlation. So when we are thinking of portfolio from finance perspective, in addition to considering return risk of A and P individually, you also need to consider the correlation between these two stocks. You also need to consider correlation between these two stocks because their correlation will impact on the volatility of the total portfolio, volatility of the portfolio. Okay. You will learn about the portfolio return calculation, portfolio risk calculation from your second lesson or second chapter. But for time being, what I'm trying to make it clear to you that you need to consider the portfolio perspective. In terms of portfolio perspective, what I'm trying to mean that you need to think how these incumbent securities are correlated. If they are highly correlated, in that case, you will not be able to reduce your risk when you will construct portfolio, including these two. If the correlation is low between A and B, you will be able to reduce your portfolio risk to a significant extent. Okay. Let's think. Let's show a simple calculation. If I open my Excel, okay, I'm trying to write two companies' name. Let's think of one is Olympic. You know the Olympic company?
Yes, sir.
It is very familiar to you for which product?
Sir, biscuit.
Right. Okay. People have not stopped consuming biscuit during lockdown, right?
Yes, sir.
Or people have reduced consuming biscuit. What do you think? Hmm?
No, sir.
Increase,
Biscuit is a, sir.
increase their consumption of biscuit.
Increase the consumption.
Yes, sir.
Yes, sir.
Okay. That is interesting. Okay. Uh, let's think of Eastern Housing Limited, EHL. Okay. I'm mentioning return risk. I'm thinking of monthly return of the Olympic stock is 10%, and monthly return of Eastern Housing Limited is 15%, and risk of Olympic I am considering 5%, assuming, and Eastern Housing I'm considering it is approximately 9%. Okay. So what is the common purpose of investing in a portfolio rather than investing in a single security? To reduce the risk. One common objective is to reduce the risk or to diversify the risk. Okay. So I'm assuming that I have invested what I have mentioned, that people usually have a tendency to invest 50% and 50%. That means equal investment, which is a kind of naive diversification, or it's also known as 1 by n rule. 1 by n rule means here n is 2. You have two instruments to invest, so n is equal to 2. So 1 by n means 1 by 2. So 1 by 2 means how much? 50%. Okay. So I'm not showing you how to calculate the what is the formula and how this formula has come, but just consider the let me show you the calculation in this way. I'm taking the W1 for what? Olympic, 50% weight for Olympic. What's the return for Olympic? 10%. I'm trying to recall you the weighted average you learned from the basic statistics course. Can you recall the weighted average?
Yes, sir.
Yes, sir.
Okay. So what is the weighted return of this portfolio?
12.5%.
12.5%. It is the weighted return. Okay. Now I'm considering that the correlation between Olympic and the Eastern Housing Limited is, as one is biscuit, one mainly produces biscuit, another one mainly produces not mainly, solely engaged in the business of real estate. Okay. So what do you expect the correlation between these two companies?
So close to zero.
So
Close to
negative.
zero.
Yeah.
Okay. I'm not so conservative, so I'm trying to think of kind of very low number, close to zero, kind of 10%. Okay. So how to calculate the variance of the portfolio? I'm showing you the calculation. I'm not explaining it. Just try to follow me. it will be made clear in your mean variance calculation class. Okay. W1 means the first instrument weight into risk of the first instrument square plus W2 into risk of the second instrument to the power square plus 2 W1, that means the first instrument weight, then second instrument weight, then the risk of first instrument, that means standard deviation. Risk, what I am trying to mean here, risk means standard deviation of the return. Okay. Then risk of the second instrument multiplied by correlation. Have you taken the additional term, the correlation I have considered? Have you seen? I have taken 0.1.
Yes,
Yes,
sir.
sir.
In this formula of calculating the portfolio risk. Okay. So I need to put an additional bracket. Okay. So this is what? This is the variance, not the risk or standard deviation. For standard deviation, what we do? The squared root of the variance. Okay. This is the square root of the variance. Okay. What's the risk now of the portfolio?
5.36%.
5.36%. Okay. What was the individual risk? 5% and 9%. Okay. If I assume that their correlation is their correlation is perfect. It's not true, but I am assuming. You see, what happened? The risk has become
Increased.
7%. You see, the risk is now the simple weighted average of individual risk, 5% plus 9%, total 14%. 5% and 9%. What is the total? 14%. If I take the weighted average equal, what will happen? 7%. It has become 7%. What happened here? Because I have taken two securities of which the correlation is very high or almost perfect. Okay. But if I if I take instrument like this, of which the correlation is only 0.05, someone mentioned that close to 0, I am taking 0.02 for example. Okay, the correlation between Olympic and Eastern housing. What happened now? 5.19. Okay. If I think that their correlation is negative, it is going down. And if I think that it is negative by 0.2, it's now less than 5, less than individual risk. You see? You see, the risk has been reduced to 4.69% when I have taken a security of which correlation is negative, not a very, not highly negative, but negative to some extent around 0.2 or 20%. Okay. So if you don't consider this correlation, you are very likely to end up some security of which correlation is 1, or can correlation be greater than 1?
No,
No,
sir.
sir.
Okay. So correlation 1 is a highest possible correlation. So if you don't consider correlation, you may construct portfolio, but you may not end up reducing your portfolio risk. Okay, so it's not a portfolio concept. When you the portfolio concept means when you include the investment, you need to consider how the instruments are related to each other. And if I considering, for example, I am considering whether I should include, for example, Walton. When I'm considering Walton, whether it is to be included in my current portfolio or not, in that case, I need to consider the correlation of Walton, for example, 0.10. What is the correlation of Walton with Olympic? What is the correlation of Walton with Eastern Housing Limited? Okay, in that case, I will be able to reduce the portfolio risk. Otherwise, it will not be possible. Have you got the simple point? That generally we don't consider. If you are not a if you are not considering from finance perspective, you are very likely to ignore the correlation issue. Okay. So by diversifying portfolio, what you are doing, you are reducing the overall volatility of return. You are reducing overall volatility of the return. Okay. Even by equal weighted portfolio, it is also possible to reduce the volatility of the return. Volatility means what? Standard deviation of the portfolio. Okay. But the thing is that if you don't consider the correlation, it is very likely that you will not be able to reduce the volatility. Okay. But even in case of equal weighted portfolio, it is possible to reduce the overall volatility. And if you look at the previous slide, if all of my investment is in Grameenphone, and Grameenphone, are you seeing my slide?
Yes, sir.
Yes, sir.
Okay. If you make total investment in Grameenphone, and you recently have heard that Grameenphone has engaged some conflict with the regulatory authority BTRC and incurred a significant amount of penalty from BTRC. Can you recall?
Yes, sir.
Okay.
What?
So if all of my investment is in Grameenphone, would it be possible to reduce the risk arising from the Grameenphone? It would not be possible. It would not be possible. So to avoid the downside risk associated with a particular company, what can you do? You can extend your investment to a number of securities rather than concentrating on a single instrument. Okay. So that is the point what I'm trying to make it clear here, mentioning avoiding the disaster. Okay. That happened also, one case you will get from your reference text, that is, if you already have, I think you already have completed the auditing course, right? You completed your auditing course?
Yes, sir.
Yes, sir.
So I'm very confident that you heard about the Enron company.
Yes, sir.
Yes, sir.
Okay. So Enron company employees are very confident with their company, and there is an opportunity for the employer to invest in the company stock. So it is also known as employee stock ownership plan, ESOP. Okay. So when employee invest heavily in their own company, because employee are biased to their employer. Employees are biased to their employer stock, employees feel overconfident with the stock of their employer, and they try to ignore the potential risk. So what would happen if their employer company fall in a disaster, and almost all of their employees stock, or almost all of their investment are invested in their employer stock? It would bring disaster for their investment.
Yes, sir.
So what would be suggestion to the investors? Not to invest in a single
Single
companies?
stock or single asset.
Okay, fine. Okay, so what would be your suggestion to your mother from today? Not to buy gold anymore like this? Or in addition to buying gold, you need to increase your investment to other instruments, right? Okay, and many of our father, we are talking much about our mother, but many of our fathers have a tendency to pour all of their money into real estate. How many of you disagree with me? Our fathers have a tendency to invest a lion's share of their money in real estate, expecting that land price will go indefinitely for an indefinite time period.
Yes, sir, that's true, sir.
How many of you disagree that my father is not such kind of concentrated investor? My father is a investor who invests in diversified assets. Anyone? Everyone listening to me?
So my father doesn't invest at all.
Okay. Okay. So that is our common tendency, because finance has taught us to find the stock and invest in that security which provides highest cash flow. So if you just take that statement altogether true, in that case, you may end up investing in that stock which gives you a highest amount of cash flow, and invest nothing of your money and nothing of your investment to other stock which are providing less cash flow. Okay. Have you heard about this risk? We are thinking of reducing risk. Which risk we are considering? Have you heard about this risk? Anyone?
So diversifiable or unsystematic risk.
Okay, diversifiable or unsystematic risk. So,
Unsystematic
risk.
so I want you to recognize the unsystematic risk with the standard definition or standard name of that unsystematic risk in the name of idiosyncratic risk. Okay, as the word is not familiar to us, many of us don't feel familiar with this word when you see this kind of term in financial news or articles. What they mention that idiosyncratic risk. Okay, so idiosyncratic risk are kind of risk which are company specific or instrument specific, which cannot be diversifiable. Okay, so by constructing portfolio, what can you do? You can reduce systematic risk, or you can reduce idiosyncratic risk.
Idiosyncratic, sir.
Idiosyncratic risk, it is unlikely, it is not possible to reduce the systematic risk by constructing portfolio. And systematic risk by definition invest all of your instruments. Okay, So the next thing, composition matters. What I have said, composition matters. I already have made the point clear that it's not like that you have in market you have 10 instruments and you have invested in 10 instruments and you are claiming that you have diversified your portfolio. It's not the thing like that. Okay, what you need to think of, we need to think of how they are correlated, otherwise the naive composition. What is mean by naive composition? Naive composition is kind of
Equal weighting.
1 by n. Okay, so it will not give you the expected benefit. And you need to think of also the trade-off between risk and return. You need to think of trade-off between risk and return. You will see this kind of efficient frontier graph in your coming classes, and you will learn how to trade off. Okay, I'm just taking a rough picture. I am considering here return, and you see my slide. Okay, I'm considering here standard deviation. The thing is that if I considering one asset here and one asset here and one asset here and one asset here, you see my cursor, the red point?
Yes, sir.
Okay, so what we are measuring here, we are measuring return in vertical axis and risk in horizontal axis. Is it? Return in vertical axis, risk in horizontal axis.
Yes,
So
sir.
if you compare this, and this, which one provides lower risk?
So the left one.
The left one. But they are providing same amount of return. They are providing same amount of return because their vertical distance is same.
Yes, sir.
So which one will be preferred by you? This one, left one?
Yes, sir.
So this is known as dominant portfolio. This is known as dominant portfolio. Okay. Now, if I think from a return perspective, you will learn about what does it mean, the efficient frontier later. It is not part of today's class. That's why I'm not explaining in detail. If you consider from this perspective, in horizontal axis, what we are mentioning, it is standard deviation, this one. And in vertical axis, we are mentioning return. Okay. Between these two instruments, which one has the highest risk? Think carefully.
So both has same risk.
Both have same risk. Okay, but which one is providing higher return?
The upper one.
Upper one. The upper one is here dominant portfolio. The upper one is here dominant portfolio. If you connect all of this dominant portfolio, you will get an envelope curve like this. If you connect all of the dominant portfolio, and you have learned how to identify the dominant portfolio. Given the risk, they will provide higher return. Given the risk, they will provide lower risk or lowest risk. Okay, so if you connect all of this dominant portfolio, you will get the envelope curve. This envelope curve is known as efficient portfolio. Okay, you'll learn more about it in your later classes. Okay. So can you recall that this picture, This almost all of these instruments have generated losses, right?
Yes, sir.
Except this. So do you think they have not made diversification well? This is a pharmaceutical company, this is a pharmaceutical company, this is a pharmaceutical company, and this is a bank, and this is food and allied company, this is power, this is telecommunication, this is in uh, I can't exactly recall right now. It's related to technology or text, probably technology, but also related to textile. I can't recall right now. Okay, it's in the. Anyone saying anything? Okay, this is a textile company. These are mutual fund. Okay, so they tried to make a good diversification, but you will ask me, instead of making a diversification, why they incurred losses? It's not a insignificant amount, because you know that the market, our stock market in aggregate was going down for last 1 year or for last couple of years, especially in after the third quarter of 2019, and it continued till 30 till the new commission has taken the responsibility in this year.
March 18.
Yeah, in March 18, what happened?
The crash happened, sir. From March 19 onward, the floor price was set.
Okay, that crash happened, but matter is that it authority has not identified that in the name of crash. Okay, matter is that crash happened several times, but the authority has not identified that as a crash. But actually, the situation got worse during March. During March, and later the new commission has taken responsibility, and the situation has become some extent positive till right now. So what I'm trying to make it clear, when aggregate market goes down, aggregate economy goes down, the portfolio diversification will not help you to reduce the risk arises from downside protection. Have you got it?
Sir, the downsides are also comes with opportunities.
Yeah, it gives you opportunities for future, but what you already have made, okay, it's not necessarily
Yes, sir,
when
that's
the
right.
market as a whole goes down, your portfolio will your existing portfolio, you can construct a new portfolio by investing in the underpriced securities for the market fall. But I'm considering the existing portfolio will not give you the protection, because the thing is that the correlation of the global market, correlation of the equity instrument, correlation of the instrument, what it was in earlier years and what it is right now has changed significantly. Earlier years, the correlation of some instruments, some markets are very low, but right now the correlation has gone up. So it has become very difficult to uh, find out the instrument or find out the market where the correlation is very low, because the overall correlation between the securities, between the market, between the asset classes have gone up. Okay. Have you heard about this person name?
Yes, sir.
Okay. So what is his contribution? Can anyone tell me in the finance?
CAPM, probably.
Sorry?
So CAPM formula and theory, maybe.
Maybe sir, CAPM formula Fisher diyesin.
Then anyone else? So you will get the story of Harry Markowitz if you search for his name in Google. But in sum up, what I'm trying to mention, once he was taking his dissertation in masters from University of Chicago. So for knowing what should be the dissertation topic, dissertation, you can think of a thesis. Okay, after having your masters, you need to have a dissertation. It's a kind of research paper. Okay, so he was talking with his supervisor, and later one day he was studying a book on investment and at afternoon in library, and he was reading a book on investment, and the book was suggesting always pick the company, always pick the security which provides highest expected cash flow. Have you got the point till now, what I mentioned? The book was suggesting always pick the investment or the security which provides highest expected cash flow. Okay, so in that case, it is suggesting that if Grameenphone, for example, provides highest amount of, or British American Tobacco or Bata Shoe Company provides highest amount of cash dividend, or expected cash dividend from Bata is Bata is highest for coming days, you will buy Bata, or you will buy British American Tobacco with all of your money. But what is the reality? Investors do not invest all of their money in that security which provides highest cash flow. Rather, investors tend to invest their money in number of securities, though some securities provide lower amount of cash flow. So markets decides that it cannot be a good investment. You need to think of the instruments separately, and how instruments are correlated with each other. How instruments are correlated with each other, because investors have a tendency not to invest in a single security. Investors generally have tendency to invest in multiple securities. So Harry Markowitz is the first person who considered, he was supposed to apply the mathematical application on a stock market. He was suggested by his supervisor to work on something that will concentrate on a mathematical application on a stock market. So he finds out that investors should evaluate each instrument by return, by R, I am trying to mean here return, and also risk. And investors should also consider the correlation by R. Here I am trying to mean what? The correlation. Have you got it? By R, what I'm trying to mean
Yes,
here? Correlation. So who suggested this first? Harry Markowitz suggested first that you need to consider the correlation among the securities what you are considering to include in your portfolio. Okay, so their relation can be measured by correlation, or their relation can also be measured by covariance. Covariance is indicated by sigma square. Covariance. Okay, you learn about it later in following chapters. Okay, so this modern portfolio theory is also known as the first theory of finance, and Harry Markowitz is known as the father of classical finance, and his concept is based on the portfolio concept of making investment. Have you got the point?
Yes, sir.
So what is suggested by classical portfolio management? You will think of return, you will think of volatility, you will think of the correlation of securities, and how you get the correlation and volatility and the return data by analyzing the empirical data, by analyzing the empirical or historical data. Got the point? So the thing is that, what is the reality? The reality is that the reality is different what is assumed by the modern portfolio theory. Modern portfolio theory has assumed that investors are rational. They collect the return data, they collect the volatility data, and they estimate that, and they collect the empirical data. Okay. So the modern portfolio theory is based on the idea that based on the normative notion. Have you heard about this term, normative notion?
Yes,
Have you
sir.
heard about this normative notion? What we mean by it?
Yes, sir.
That people are rational.
No, sir.
People are rational. Okay. If you don't learn, if you don't hear about it, let's try to understand. The purpose of this notion is that they consider that how people and market should behave, and how they should behave, and people actually behave in that way. How people should behave and people actually behave in that way. That is the normative assumption. That is normative assumption. Okay. So right now I'm taking your class, and what I'm assuming that you are attending to my class with with your highest amount of concentration, and you are attending the classes regularly, and you are very prepared, and you finish your class lessons properly. This is kind of what should be. Are you getting my point?
Yes, sir.
Okay. So this kind of assumption is kind of normative notion, what it should be, and how people should behave, or how market should behave, and people and market actually behave in that way. This is kind of assumption by which philosophy? Normative philosophy. That investors are rational. Can you recall this person name?
Yes, sir.
Yes, sir.
You have spent a good amount of time to learn how to accommodate the new information with your probability, existing
Yes.
probability. Can you recall? Okay.
Yes, sir.
So why it was necessary? It was necessary because investors make decision rationally, and whenever they get new information, they update their probability, they update their expectation with the new probability, new information, and that is kind of Bayesian adjustment. And people who behave in that way, they are known as Bayesian. People are known as Bayesian who follows the Bayes. Bayes is not the Bayes. Here, Bayesian means the followers of Bayes. Okay, can you recall the Bayes? The Bayes has
Yes,
given
sir.
the Bayes theorem in most probably 1700 decade, approximately 400 years ago. Approximately 400 years ago from today. So if people are rational, whenever they get new information, what they will do? They will update their probability with the Bayesian formula, and they make decision based on that. Okay. And you heard about the utility concept from your microeconomics concept?
Yes, sir.
Okay. So what people usually try to do, they usually pick that item which gives the higher amount of utility.
Yes, sir. There is a rational thinking.
That is the rational thing. But what is the reality?
So sometimes people are irrational.
People are mostly rational, not sometimes irrational. people are mostly irrational. Okay, let's think of a simple case from your home. Okay, uh, between fast food and the homemade food, which one is preferred by your society? Between fast food and the homemade food, which one is preferred by your society?
Fast food.
Fast food.
Fast food.
Fast food.
Which one is mostly consumed by your society? Fast food or homemade food?
Homemade food.
But the utility is higher in which food? Fast food.
Fast food.
Instead of having higher utility, higher satisfaction with the fast food, people don't like to eat the fast food regularly. Is it true?
Yes, sir.
Yes, sir.
So that is the first attack to the utility theory. And Bayesian people should adjust their probability or expectation based on the new information. Okay. So if you follow the Grameenphone stock, when Grameenphone has decided, or Grameenphone has been instructed to pay the penalty to the BTRC by a due time, decision took by the High Court, some people still went to buy Grameenphone. Do you think they were Bayesian?
No, sir.
Because they have not updated their probability. They are still optimistic about the prospect of Grameenphone, prospect of the cash flows, and they didn't consider the changes in the information. In contrast to the assumption on which modern portfolio theory is based, the new concept is behavioral finance. You probably have heard about it, right?
Yes, sir.
Till now, 4 people from the behavioral finance field have achieved the Nobel Prize because they studied on behavioral perspective. Okay. So, alternative to normative action, the positive notion assumes that people don't behave in that way how they should behave. People behave in a different way which is not rational. People behave in a different way from rational way. Okay, that is the reality. So what people do, people don't consider base formula. How many of you probably set your expectation for your CGPA before getting result for last semester? You set an expectation?
Yes, sir.
Okay. When you get new information, how many of you have considered the base formula to update your probability? Anyone? No one? Okay. Traditional finance assumes that people are risk averse, right?
Yes, sir.
If people are risk averse, why people purchase the lottery ticket? instead of knowing that the outcome is close to zero. Why people buy lottery ticket? Have you ever heard that this institution has initiated lottery and this institution couldn't sell this amount of lottery? Have you ever heard about this kind of news?
No, sir.
No, that means all lotteries have been sold off. So who have bought this lottery? Risk averse people or risk
Almost
loving
all of
people?
us.
Risk averse people or risk loving people?
Risk loving.
Risk loving people.
Risk
So
lovers.
the assumption what has been made by classical finance or the assumption what has been made by Harry Markowitz are not very applicable nowadays. People don't have perfect information. People are not necessarily risk averse. People don't consider base formula. So nowadays, portfolio manager instead of considering only return, only volatility, only correlation of securities, nowadays what they are doing, they are constructing portfolio based on some behavioral factors. Based on some behavioral factors. How behavioral factors help you to construct portfolio? For example, people have very much pessimistic about the ACI. Have you heard about the ACI?
Yes, sir.
Okay.
Savlon hand sanitizer.
Yeah. This company. Okay. If you look at the past return, you will end up that ACI didn't provide a good amount of return in previous days. So according to classical portfolio theory, what you will consider? You will not invest in ACI because they have not provided good return. Okay. But and people have let's assume that people have become very much pessimistic about the prospect of ACI. What will happen? ACI price will go down.
Yes,
What
sir.
will happen? ACI price will go down if people get pessimistic. Okay.
Yes, sir.
So in that case, behavioral portfolio manager take position in ACI because they are considering that people have become pessimistic with the ACI. That's why ACI price has gone down. However, the future of as the price has gone down, it is lower than the fair value. It is lower than the fair value estimate. The market price of ACI right now is lower than the fair value. Why it has gone down below fair value? Because the investors have become pessimistic, and investors have become pessimistic. Why investors have become pessimistic? You may not got a good number of reasons. Investors have become pessimistic for several reasons. It can be like that investors in aggregate don't like to buy the securities which are in pharmaceutical and chemical. That may be a reason. Okay. In that case, it can be a good investment for which people? Behavioral portfolio manager, because they are analyzing the behavioral factor of the market, and investors are pessimistic, and behavioral portfolio managers will try to take position of those stocks or those assets which seems to be profitable from the behavioral analysis. Okay, so we'll talk about more of this behavioral portfolio management later of this course. Okay, so we'll try to conclude with the portfolio management process. So when you have money or you have been entrusted to use the money of individual or institutional fund, would you please mute your volume so that noise will not come here? Okay, so when you have money, what are the basic process you need to follow to construct a portfolio or to manage a portfolio? Okay, first of all, you need to understand the client's need. You probably have heard about this from your investment analysis course. Can you recall?
Yes, sir.
Investment policy statement.
Yes,
Because
sir.
investors liquidity need, investors objective, investors income need, these are different. Okay, uh, so in that case you need to understand, for example, between two people, one person may be interested to invest in equity only, one person like to invest in long-term investment, not to invest in short-term securities. So you need to understand the client's need very carefully, in which stage, planning stage. And you need to also understand the risk tolerance. So by risk tolerance, uh, you need to collect information, and you need to have a survey that how investors react to several situations. Like if market goes down by 20%, will you become very nervous, or will you withdraw all of your money, or you withdraw 50% of your money? So if the person is very risk averse, it is very likely that that person will give yes, I will do so in that survey question. But if the person is risk tolerant, that person will give unchecked in that question. So considering that, what you need to make, we'll talk about more detail about this. You need to prepare an investment policy statement. Have you heard about this in your investment analysis course, IPS?
Yes.
Yes, sir.
Okay, it is not instant power supply.
Yes, sir.
Okay, so if you just see these three letters in finance environment, don't misunderstand it as instant power supply. It is kind of investment policy statement. So when you have prepared your investment policy statement, not your client. Who are your client? Your client can be individual, your client can be institutional. Who are you? Your portfolio manager. What are you doing? You are managing a portfolio. Right now, what we are doing, we are trying to learn what steps we need to follow to manage a portfolio. Okay. First of all, we plan about the portfolio management process. Okay. Then what we need to do, we need to execute based on what? Based on the IPS. IPS will mention that which one is preferred by investor. Okay. So for example, there is a rule of thumb. I am assuming that your age is now 22. How many of you don't agree with your age, 22 average age? Anyone disagree that our average is higher than this or lower than this? No one.
So 23 maybe.
23 average. Okay. I'm taking this 22.
Yes,
So
so more or less 19.
19 first year.
1997 sir, more or less সবাই.
1997. Okay. In that case, we need to think of 23. Okay. You are not as younger what I'm thinking. Okay. So there's a rule of thumb. Rule of thumb is like this. 100 minus your age is equal to your investment in equity asset class. 100 minus 23 should be invested in equity asset class. What do you think? But I'm trying to make it clear that when your age is 23, you are more risk tolerant compared to the person of whom age is 46 years. Is it?
Yes, sir.
Yes, sir.
So in that case, your portfolio should include more of equity asset class or fixed income asset class.
So equity asset class.
Yes, equity asset class.
Equity.
Good. So this is the first step you need to decide that how you allocate your asset. So how many asset classes right now we have? Traditionally, there are 3 asset classes. One is equity asset class. Second one is fixed income asset class. Third one is cash. But right now, we consider another asset class, which is alternative asset class, alternative investment asset class, of which features are different. Asset classes are distinctive based on their distinctive features, and you can separate the equity from fixed income. You can separate both from cash, and you can separate real estate investment, hedge fund investment, then cryptocurrency investment, then metallic investment, investment in commodities, investment in future, derivative investment. These investment are distinctive from equity asset class and fixed asset class. Okay, so the thing is that you need to think of this. For example, we have 2 examples. One is of the investment by the university endowment. You see their asset class. These are some sub-asset class they have considered, but broadly speaking, the asset classes can be categorized into 4. One is equity, another one is fixed income, third one cash, fourth one alternative asset. You see in which asset class this university has invested highest amount. This kind of alternative investment. Have you got it?
Yes, sir.
Okay. And which one is second?
So public equity.
Equity. And compare their asset allocation with a mutual fund. It's a kind of mutual fund asset allocation, which is their it's most probably bond mutual fund. That's why they have invested more than 50% in bonds. Okay, have you seen the differences in asset class preferences? They invest in equity. How much only? 9% of their portfolio. So it's kind of fixed income mutual fund. They are, and they also have real estate investment, mortgage investment, policy loan, partnership, and other asset. And they are out of their total investment, only 2% is in cash. But in case of the Yale University, their cash is 1.2% of their portfolio, and University of Virginia, their cash percentage cash is 2.3%. Okay, make it clear. When it is mentioned is cash, it does not mean dollar, taka, coin. Here, cash means short-term money market instrument. Am I clear to you? Kind of treasury bill, short-term treasury bill,
Sir.
kind of repo, kind of this kind of short-term treasury bill. Okay. So these are not absolute cash. Don't expect that they have kept their cash balance in drawer, or they are under the table, like this. Okay, so you got the point. Asset allocation, that what you need to do, for example, you have got that you will invest 77% of your money to the equity. So I'm assuming that that is 77 taka. How much that is? That is 77 taka. So when you invest in equity, you need to analyze the security. Right now, we are considering equity security. Which equity security you need to invest? Is it Grameenphone, or is it Olympic Industries? You need to analyze. And I'm very much confident that you learned about it very well in your analysis of investment, and also from your financial statement analysis and valuation course, how to analyze the security and how to pick a security out of the 300 securities or 500 securities. Okay, then you need to construct portfolio. How you construct portfolio? Let's assume that you have picked 5 securities. How many? 5 securities. Now you need to assume that you need to find out, when you analyze the security, you also need to, from portfolio perspective, what I have mentioned separately, other than the return and risk, you also need to consider the, what it is?
Correlation.
Correlation. So based on that, you will construct portfolio. So if your objective as an investor is to minimize risk as minimum as possible, in that case, you will try to find out those securities of which correlation is very low or close to zero or negative. Is it true? Otherwise, you'll not be able to reduce your risk or minimize your risk. If you are an investor of which objective is maximize return, in that case, you need to sacrifice some of the increased risk. Okay. So considering that your objective, the correlation among the securities, you need to construct your portfolio. Okay. Then your execution is done, and regularly portfolio monitoring and rebalancing is essential. It is not like that you have constructed portfolio on January 1, 2020, then you went to sleep and you woke up in October 15, 2020, and you are seeing that 50% of your portfolio has been washed away. It's not like that. Have you got it? You need to constantly monitor your portfolio. You need to constantly monitor your portfolio. That's why you will see that portfolio managers in developed countries. I had an opportunity to participate in a session who looks after the behavioral perspective in his investment company, where she installed the blood pressure meter. Kind of, you probably know very well. There are kind of digital devices. If you wear those devices, your blood pressure can be computed. Are you familiar with that device? Okay. So they have a practice that they will engage, they will want their portfolio manager to wear that gadget, and their blood pressure can be 140 plus. And all of their portfolio managers' blood pressure will be monitored by the behavioral perspective department or behavioral finance department. What's the reason? Why the blood pressure is expected to go up? Because when the market turmoil starts, you need to increase your monitoring. I'm not telling about the monitoring of blood pressure. What I'm telling here about portfolio monitoring. If you see that, for example, few days, not few days ago, probably day before yesterday, the regulatory authority has fined 1 crore taka to ACI for using methanol in their sanitizer instead of using ethanol in their sanitizer. Have you heard about this news?
Yes, sir.
Yes, sir.
So immediately listening of this news, what you need to do? You need
So we need to
to
sell our ACI stock.
rebalance. You need to rebalance or sell or buy the ACI. I'm just giving an example. Okay. So if you would not monitor, if your portfolio includes ACI, you need to be very careful to rebalance the ACI holdings. Okay. Then at the end of the period, what you need to do, you need to check the performance of your portfolio. For example, in your IPS, your client mentioned that if DSC, I need to get 2% margin above the DSC return, above the DSC return. For example, at the end of the year, it has been seen that DSC generated return of 12%. How much? 12%. Now, what is the benchmark return based on IPS? Benchmark
14%.
return is 12%. Benchmark return is 12% because in IPS, your client said that my portfolio need to achieve 2% above DSC return. 2% above DSC return. At the end of the period, if you see that DSC achieved 12%, but you achieved as a portfolio manager 5%, will your job be retained?
No, sir.
Your job, you will be fired off from managing the portfolio of the client. Okay, you will not be happy because he has not got the 2% margin as expected above the DSC return. So there is a tendency among the portfolio manager to report the performance in a way which will not enable the client to understand the true performance of the portfolio. So will you do so? There is a common tendency among the portfolio manager to report the performance in a way which makes it difficult for the client to understand how was the performance of the portfolio manager. Will you do so when you will start your career as a portfolio manager?
No, sir. That will be unethical, sir.
So that will be unethical. That's why the professional education starts with ethics, because the investment managers have skills, have their knowledge, but most of the time it is found that they are not ethical in measuring the performance or in a way how they interact with their client. Okay, so this is one way. Another way can be, for example, right now, I'm assuming the risk-free rate is 6%. So your client has said that my portfolio should achieve 3% above the risk-free rate, above the risk-free rate. Okay, so in that case, for example, if you achieve 2% performance in your portfolio, that what does it mean? It means that you bet the benchmark. You bet the benchmark because you bet the benchmark by how much percentage? 2%, but actually you couldn't meet the objective of client